You can invest for 20 years, earn solid returns, build a six-figure portfolio, and still lose tens of thousands of dollars quietly to taxes. Not because you picked bad investments, but because you placed them in the wrong account. Here's what most people don't realize. In the early stage of building wealth, your contributions matter more than your returns. Let's say you earn $50,000 salary, $20,000 investment income. If that investment income isn't positioned correctly, it can push you into higher tax brackets, unnecessarily. Most people understand asset allocation, but very few understand asset location. Allocation equals what you invest in. Location equals which account you put it in. The principle is simple. Put tax-inefficient investments inside tax-advantaged accounts. Put tax-efficient investments inside taxable accounts. And once you understand this, you'll never structure your portfolio the same way again. Tax-inefficient assets. REITs, ordinary income. High-yield bond funds. Covered call ETFs. Actively traded funds. These generate income taxed at ordinary rates. Tax-efficient assets. Broad index funds. Growth ETFs. Individual stocks held long-term. Qualified dividend stocks. These benefit from lower long-term capital gains rates. Yield means nothing if 30% disappears unnecessarily. Investors often hold REITs inside IRAs. Hold broad market ETFs in taxable accounts. Avoid high-turnover funds in taxable accounts. Use Roth accounts for high-growth assets. That's not complicated, but almost no one does it intentionally. How to pay zero taxes on $40,000 to $90,000 of investment income. This is where people get surprised. Under current U.S. tax law, long-term capital gains and qualified dividends can be taxed at 0%. Not low zero. If single, up to about $49,450 taxable income. Married filing jointly, up to about $98,900 taxable income. Here's what matters. This bracket applies to taxable income, not gross income. That means you subtract standard deduction, retirement contributions, HSA contributions, above-the-line deductions. Let's say about married filing jointly, $30,000 part-time income, $60,000 long-term capital gains. Total equals $90,000 gross income. Standard deduction, $29,000. Taxable income is almost equal to $61,000. That entire amount can fall inside the 0% capital gains bracket. Result: you pay zero federal tax on the $60,000 capital gains. This is income stacking. Ordinary income, wages, interest, fills the lower brackets first. Long-term capital gains sit on top. Hidden strategy number 1, controlled realization of gains. Do not sell randomly. Harvest gains deliberately in low-income years. Example: you take a year off. Your earned income drops. That is not a bad year. It is a tax opportunity year. You sell appreciated stock. Reset your cost basis. Pay 0% tax. Now future gains are reduced because your basis is higher. Most people only sell when they need cash. Investors sell when the tax math makes sense. Hidden strategy number 2, qualified dividends. From the dividend-focused strategy, high yields look attractive, but evaluate first. Is the dividend qualified? Qualified dividends are taxed at capital gains rates. Non-qualified are taxed as ordinary income. That's why many investors prefer broad index funds, dividend growth stocks, low turnover ETFs, over ultra-high yield vehicles and taxable accounts. Yield without tax awareness is short-term thinking. Now we move into tax loss harvesting. Here's how it works. If an investment drops below your purchase price, you can sell it and realize a capital loss. That loss can offset capital gains. Offset up to $3,000 of ordinary income per year. Carry forward indefinitely. Example: you have $40,000 capital gain, $15,000 unrealized loss. Sell the losing position. Now, $40,000 gain, $15,000 loss, equals $25,000 taxable gain. You just reduced taxes legally. You cannot sell a stock for a loss and immediately buy the same one back within 30 days. But here's what you can do, for example. Sell S&P 500 ETF. Buy a total market ETF. Similar exposure and not substantially identical. That is precision investing. Hidden strategy number 3, 0% bracket. Most people think income is fixed. Treat income as adjustable. The goal is simple. Lower ordinary income enough, so capital gains fall into the 0% bracket. Let's walk through a realistic structure. Scenario: early retirement or semi-retirement. Married couple, $25,000 part-time income. Portfolio generating $70,000 in long-term capital gains plus qualified dividends. Gross income equals $95,000. Standard deduction is almost equal to $29,000. Taxable income is almost equal to $66,000. That entire amount can fall inside the 0% capital gains bracket. Result: $70,000 investment income. $0 federal tax on capital gains. This is common among financially independent households. It's lower earned income intentionally. Hidden strategy number 4. Use conversion. Roth conversion means moving money from a traditional IRA to a Roth IRA and paying income tax on that amount today. Why would you do that on purpose? Because tax rates are not fixed forever. If you're in a low bracket now, it may be cheaper to pay tax today than later. Think of it like this. Pay 10 to 12% now, instead of 22 to 24% later. That's the core idea. Instead of leaving your traditional IRA untouched, you convert just enough each year. Fill up the 10% and 12% tax brackets. Stop before jumping into higher brackets. You're choosing your tax rate. Hidden strategy number 5. Asset location. Put the right assets in the right account. Most investors mix everything everywhere. That creates unnecessary tax drag. Instead, assign jobs to each account. Traditional IRA is best for bonds, REITs, high-yield income funds, high-turnover strategies. Why? These generate ordinary income anyway. Traditional accounts already defer ordinary income. You're matching tax type with account type. Roth IRA is best for high-growth stocks, small-cap funds, aggressive index funds, long-term compounders. Why? All future growth is tax-free. If something could multiply over decades, Roth is where you want it. Let the biggest winners grow where taxes never touch them. Taxable brokerage account is best for broad market ETFs, dividend growth stocks, low turnover funds, long-term capital gain assets. Why? Long-term gains have lower tax rates. You control when gains are realized. Assets receive step-up in basis at death. Hidden strategy number 6. Medicare IRMA awareness. Few investors understand this until it hits. Higher income in retirement increases Medicare premiums. These are income-based surcharges. Roth conversions done strategically before age 63 can reduce lifetime IRMA exposure. This is long-range tax engineering. Track income thresholds. Know their tax brackets. Plan withdrawals. Monitor year-end tax positions. And don't react in April, but adjust in November. Hidden strategy number 6. Charitable giving optimization. Instead of writing checks, investors donate appreciated assets. Here's why. If you donate appreciated stock, you avoid capital gains tax. You receive a deduction for fair market value. You remove the asset from your taxable estate. Example: you bought shares for $50,000. They're now worth $200,000. If you sell, you owe capital gains tax on $150,000. If you donate the shares, no capital gains tax. Full deduction for $200,000, subject to limits. This is clean, efficient, and legal. If I were guiding someone serious about building and protecting wealth today, here's the framework. Build aggressively early. Focus on contribution discipline. Structure assets by tax efficiency. Learn income stacking before retirement. Use Roth conversions strategically. Protect against unnecessary Social Security taxation. Donate appreciated assets, not cash. Design withdrawals decades in advance. This is not about tricks.